So yesterday I had the good fortune to phone up Manny and give him a bit of background on tonight and get his bio and go over the questions and all that kind of stuff. And I was really impressed with that 15-minute conversation. I actually learned a lot in it, and I was inspired from it. And so I think everyone's going to learn a lot here tonight about angel investing and be inspired by it. So a little background, there's an organization called the National Angel Capital Organization, NACO. And so they have a big annual event. Last year it was in Vancouver. And so I went and was going to all these different sessions and talks and stuff. And so I got to hear Manny. He was talking about mentoring and coaching different startups, and he was on a panel. I got some good stuff out of that. And then later on that day, NACO voted Manny Padda as Canada's top angel investor for 2016. So I think he deserves it. And so we have a real treat with us here tonight. Yeah, so a round of applause. That might be our only one, but
yeah,
we'll
be slow
take
clapping after, but that's okay.
Yeah, so a little bit of bio on Manny, and we'll unpack a lot more through the interview. But Manny is an island boy. He was born in Duncan, lived there until he was 18, and then the big city of Vancouver pulled him over. So he was getting school at SFU.
Hello?
Should I talk louder?
I think this is gonna work, hopefully.
Okay.
You wanna try? I'm gonna turn it up.
No problem.
Perfect. And so Manny was going to get into investment banking. But according to him, luckily one of his mentors talked him out of it. And so he got into more on the human capital side, and he started a company doing a lot of corporate recruiting. Started at a young age, sort of mid-20s, 25. And it did really well. He got to work with a lot of great companies in Canada, the US, and around the world, and then set up offices in many different cities.
In a few different cities, yeah.
Few different cities, but like London and
chat more about it.
Yeah, we'll go over that. And so through that, he got exposed to a lot of great tech companies and ultimately angel investing. So we'll talk about that a bit. And let me pull out my sheet because I took some notes. So Manny's been angel investing for about 7 years. He's got close to 40 companies, and he does it through his company called New Avenue Capital, which is predominantly him. So it's not a fund; it's his own personal capital, and his New Avenue Capital is focused on three main things. So one is financial, so investing into tech companies, but also financing them in different ways. Still does human capital, so still recruits for certain key clients, but that's not his full-time thing, but he really enjoys that. And then also impact. So Manny's looking to help and support setting up 1,000 schools around the world, which is pretty awesome. And he's a good family guy and has a son who's 3, another one on the way. And I looked up on the internet, so the last little factoid is he recently donated $227,000 to Science World for kids' science education. So I thought that was really cool. But that's, and then he took like a VC and private equity programs at Stanford and Harvard, and so he's kind of schooled in that. So
How that sucks.
yeah, so that's kind of a side note, but I guess
That's the theoretical.
yeah. But so for tonight, I got a good list of questions from Stephanie Andrew, and so I'll work my way through the list. It'll be a bit free flow, and then at the end, we'll also take questions from anyone in the room as well. But I was kind of thinking, if there's like a really good story that Manny's sharing and someone has a really good question that's timely and relevant for everyone, we can kind of freestyle it a bit and people can ask questions throughout. So there's going to be a dedicated time at the end, but if you want, you can raise your hand and we'll go from there. So without further ado, I'll work my way down the list. So Manny, how did you get started in angel investing?
Let me take that.
Yeah.
So James gave a little bit of my background, and by the way, it's great to be here. I actually miss the island. I don't get a chance to make it over here as often as I want to, so great to be back for a couple of days. So James mentioned my background is I was supposed to be in finance. I was supposed to become an investment banker, make tons of money, enjoy the life, and that comes along with it apparently. But I had a very good mentor of mine who I worked with, who told me at a young age, we were about 22 at this time, just graduating, that Manny, I don't see you working for a company for a long period of time. Not because I don't think you can do it, but because you have large problems with authority. And so let's instead figure out how we can channel that into a positive method or manner and build something out. And so he said, you like networking, you enjoy working with people, let's look at recruitment. And I was like, recruitment, I don't want to recruit engineers, I don't want to recruit secretaries, I don't want to recruit these type of people. And he said, that's not the type of recruitment I'm talking about. The recruitment I'm talking about will put you in a firm which will set you up with networks and relationships that you can leverage for the rest of your life. So he said, let me introduce you to a firm called Korn Ferry. And I said, immediately stop right there. I'm never going to work for a company called Korn Ferry. That's not happening. And he said, no, take a look. So I started researching it, and Korn Ferry actually is considered one of America's 50 greatest brands. They're the largest executive search firm in the world. They do headhunting globally, so for all the Fortune 500 companies, they do the C-suites, the boards. They're like one of the big four accounting firms, but for executive search, all retained. So it's not contingent. You pay them, when they start the search. So I was very fortunate at a very young age to be able to work at that firm. I was 23, and everyone was 30 and above, so I got to learn a lot. But one thing it really taught me was so many different types of industries and companies. I ended up working my way where I ended up working for the head of mining and metals globally for Korn Ferry, which was kind of cool. Did work in about 20 some odd countries. But I always had that itch to go do my own thing, surprisingly. And so what I ended up doing was I did my MBA at Queens while I was at Korn Ferry, and then I left and started PM Search. And what PM Search was competing against Korn Ferry, which was a lot of fun, and other firms. But what I really realized was to leverage and to build, I always wanted to do investing. And so what I started doing was I started doing a lot of searches with early stage tech, natural resource companies, and I started taking my fees in stock. So I said, you know what, I believe in this company. I'm going to place executives here that I think are going to blow this company out of the water in terms of building out valuations. I'll put my money where my mouth is. And I still do that today. And so that's how I got my start in angel investing in terms of learning and understanding companies. And that's kind of where my background melded. And where the Harvard and all those things come in is I really wanted to hone those skills. So I ended up going to Harvard to study venture capital, private equity, really to get that backbone understanding of deal structure. And I'm sure these questions are going to come up, but really it's just been the experience over the 7 years, I'd say, that's gotten me into angel investing, and I'm still learning a lot. A lot of mentors in Vancouver and globally, which we can talk about. But the portfolio now is, with all those search works and all the contacts I've got globally, we've got 37 ventures in 12 different countries now.
Yeah. So, what is your investment thesis? So, like people in this room are maybe wondering, like, what types of companies do you invest into? What are you looking for?
Sure. So if we're looking at it from an early stage perspective and on the technology side, I've got a pretty straight thesis. Pre-5 million valuation. I prefer equity, not convertible notes and safes. I want to see a minimal byproduct or a beta out, but I don't care about seeing traction. So I want to get into the super risky stuff. Someone just talked to me and said, Manny, why aren't you an LP in a VC fund, etc.? Because I want to be in the riskiest stuff possible. This part of my portfolio and the business that I run is for the ones that 1 in 20, 1 in 15, I'm looking for unicorns. And so I want to invest in businesses that are that level where if they sell it for 100 or 200 million, and I got in at 2.5, that's 100x, and that's what I'm looking for. Other parts of the portfolio, depending on what we're doing, so we have the capital, as you mentioned, is 3 pillars. The financial is early stage investments, and then afterwards with some of the companies I've been working now, we're actually helping them go public or exit. And so that's the 2 pieces that we do there. And then if they need help in between, we actually lend to them. So I do debt lending in the tech space against government grants, shreds, etc. So on the pure investment side, that thesis is there, and then on the other piece, it depends where the organization's at.
So you've invested in 37 companies, and so most of the angels in Victoria haven't invested that much. So maybe besides Thomas. What have you learned in all your experience of angel investing for other angels in terms of do's and don'ts, and what kind of themes are you pulling out?
I feel are making me feel smart. So let's say it's been more than 37, but a lot of flamed out as well, and that's what's expected in the angel investment portfolio. Is that a lot do flame out? I think the biggest key I've had, I was trying some new individuals who wanted to become angel investors. I said, man, how do I learn angel investing? I gave them all the tools. You can go to NACO. Here's all the education pieces. Here's all the activator networks. Here's all the incubators and sellers in Vancouver. Here are all the pitch events. But if you really want to learn about angel investing is done by investing, right? It's writing the checks. It's getting the experience. It's having your money in there and seeing what goes wrong, because a lot of things go wrong. And I think we're recording, correct? Okay, so I'll be very careful how I phrase some of these things. Won't name any companies, etc. But I think it's important to do that. So a few things that I've learned is, I typically used to invest in the most charismatic person in the room, and that's a mistake I think most angel investors make. And I think a lot of individuals who think of angel investors think we must be really smart people because we're investing as angel investors. No, we're just investing because we have money to put forward. Accredited investor doesn't mean smart investor. It means we have money to lose, right? That's essentially what we're doing potentially. So that was usually what I'd go for. And now I've realized that I really look for the solid entrepreneurs, and this is just my thesis, that I look for not the charismatic narcissist, but I look more for the individuals who tell me where the problems are in the organization, keep me updated really quickly, are proactive when stuff's going bad, and not reactive or going silence. Those are some of the keys I look for in an entrepreneur. I tend to prefer to invest in women, not men. The reason for that is through our portfolio, what I've been seeing in the new research that's coming out is women tend to do more with less, a little bit more rational and reasonable on their expectations, and keep things viable. And so some of our best portfolio companies, My Best Helper, and a few others, Lbox, etc., are doing very well. And that's not saying we don't invest in men, just giving you some examples. But that's typically what we look for. So at that early stage of a company, and as an angel investor, if you're investing in an early stage company, really you're betting on the jockey, not the horse, right? The business that you invest in, if you write a $25,000, $50,000, $100,000 check, that business is not going to be what they end up building, especially in my case, because sometimes I'm before they even have traction, and I prefer that, because then we can help them save money as they're building. But it won't be the business that they build, and very likely will definitely not be the business that they exit. So when you're looking at the pieces, I always look at the entrepreneur first. Are they coachable? Are they putting the right people around them in terms of teams? Are they realistic in what they think they want to do? The two graphs I love seeing always, I just think they're hilarious, is that hockey stick, right, which everyone talks about, but the second one where it's like, here's the 4 quadrants, we're in the top right, and LinkedIn sucks, it's in the bottom left. Like, we blow them out of the water, right? And so those are 2 graphs I always see that are red flags for me. I want to see entrepreneurs who say, listen, here's the path, here's what we want to build, but we need help around us to do that. And that's also based on the level of investment and the stage I'm doing it at, pre-seed and seed. Right? Once you get to Series A, Series B, you sit down with VC firms, your attitude as the entrepreneur needs to change a little bit. But as early stage with what I want that honesty, I want that approach, I want that coachability, and I want that relationship to be a positive relationship. Because the angel investor you take on should not just be money, but it should be smart money. And for yourselves as well, you want to be that in terms of the companies that you're investing in.
Yeah, you mentioned coachability a few times there. I just recently read a book called The Sales Acceleration Formula by the CSO of HubSpot. And so he was a data guy, and he looked at all the different factors of his sales team and what was common for the most successful salesperson. And it was coachability, the ability to be mentored. And so you're kind of bringing that up for entrepreneurs as well. I just thought that was a interesting correlation. But so what is New Avenue Capital, and how long have you started? What's its vision? What all are you doing with it?
So New Avenue Capital is my business, and as I talked about, there's the 3 pillars. So we do the financial, equity and debt. We do the human capital. My wife jokes around that our tagline is by application only, because we only work with clients that I've worked with previously or who get referred to us, and it's only C-suite and board, fully retained, minimum fees, etc. And then it's the impact capital side. And that's probably what takes up most of my time. And I push it on any angels or anyone wants to learn more. I've got a goal of not 1,000 schools specifically, but educating 1 million kids. And we do that through 3 ways. So at UW Capital, what I do is either the traditional investments and the donations that James was talking about. We invest in social impact ventures, so I'm invested right now in about 8 specific social impact ventures where I've taken, and I've said I will take less ROI based on you hitting these tangible outputs in terms of what you're feeding, et cetera, what you're doing in the community. And then I'm also a professor. So I'm an adjunct professor at SFU, and I teach resourcing new ventures. I'm an investor in residence at TMBT, the next big thing, and I'm an investor in residence at SFU. So all those pieces that we're doing, the goal of all those things is to educate kids and to be able to build. Kids and education is my key. And so as an angel investor, part of our job, and I think, is to help educate the entrepreneurs and vice versa, right? I'm fortunate, I think I'm still in between ages that I hopefully can relate to millennials, but I've got about 5 years and then I won't. And so I'm trying to learn as much as I can from a lot of these early stage startups and mentors about what's new, what's the trends, etc. Because technology is changing so quickly these days, right? It's not like 20, 30 years ago where it took 10 years for cycles and companies to have to move forward. Now, a BlackBerry collapse can happen in 2 years, right? In terms of companies moving forward and all of a sudden being obsolete. And so being able to stay on track, being able to work with that, I think is key. So for New England Capital, you're asking me what we want to do going forward. I've always said I never wanted to have a day job. So I never wanted to have a new job where I have to be in the office every day. I go to the office every day, but I don't want to. And that's what continue. We've got a couple employees, one who helps me with the portfolio, and one who, if anybody watch Suits, Mike going on in the background, takes care of everything. I've got my foundation, Gratis School, my not-for-profit, and I've got a couple associates there, and I fund that, and that's it. And my goal is not to build an extravagant team, build out. My goal is to invest in some really cool companies, find some really cool people for some really cool companies, and build an education platform that people can look back and go, wow, that's actually educating a million kids. So that's what we want to do.
So you kind of answered this already, but just building on it or being more explicit about it. Why do you angel invest, and like, what do you consider the best part about angel investing? Because you could make probably more money just lending, real estate, focusing on corporate recruiting.
I think angel investing. So I used to also be into poker a little bit. So I think a portion of it is gambling. Like, I will be honest, right? It's legalized gambling in some ways. So if my wife sees it, she goes, "Hey, it's companies you're investing in." I'd say about 20% is probably that, to be brutally honest, right? We're taking risks, we're taking bets. It's essentially what we're doing, right? Sometimes people will say we're spinning the wheel. Like, my dad is an immigrant, and he would listen to me one day, and I was explaining to him. He goes, "Wait a minute, let me get this straight. You invest in 10 companies hoping one does really well," and then he goes, "I think you need some more education potentially because those numbers don't make sense, right?" So I think a part of it's that. The second is diversification. So yes, I do passive lending, I do recruitment, I do all these things, but this is my super risky stuff that I enjoy, that I want to do. And third, I think now that I don't operate a business full time anymore, this allows me to kind of jump in and out. So people go, "What do you do for a day?" And I go, I'm literally in touch with a lot of the companies that I'm working with, opening doors, opening networks, helping build out. I've invested in 4 companies this year, so I'm starting with them, and we're always working. So for me, it's the enjoyment of working full time with companies, but being able to leave. It's like when you go babysit your nephew or niece, right? They're really great, but as soon as they start crying, you can hand them back, right? So here we go. I'm gonna open up all these sales doors for you. Now you go make the calls, right? So I really enjoy that piece. And then I think finally is a little on the education side. I've been really blessed to have some amazing mentors, and still do. I've got 7 years angel investment experience, but there's guys in the space and girls who really been teaching me, the Jim Fletchers, the Praveen Varshanis, all these type of individuals in Vancouver and globally, so that knowledge can try to get passed down. So hopefully once I've got 20, 25 years angel experience, I know what I'm doing better than now. And I think that's the key in the piece is I've had so much experience, education, development. This allows me to do some of that work as well on the social impact side and work with really cool people. I had a great successful recruitment firm, but it's really lonely being one, right? Like being the boss and CEO, you can't talk to people. When stuff's going wrong, and as much as families around, it's tough for them to understand. Now I'm working with entrepreneurs, people around me all day that keep me energized. And I'm hoping that, I feel more alive today than I did 5, 7 years ago, or 6 years ago when I had my own business. And I'm hoping that that's going to continue as I continue to invest and develop. So it's being around smart people, it's developing cool companies, but at the end of the day, you can go home.
So, how do you think about or manage like deal flow and screening and due diligence? I don't know, that's kind of three questions, but
Well, that's really easy. The first thing I do is I don't take cold calls. The only way to get a business in front of me is to have it referred by somebody I know. So that is my first and only screening tool. After that, if someone refers me a business, I will take a look at it. If it's value higher than 5 million, it's put away, I don't even read it. And then underneath that, then I go through their criteria. If it's life sciences or hardware, I don't touch it. I just open up the spaces I look at investing in. And that's typically the way we look. Last year we saw 367 deals, I believe, that made it through the first stage referred. And then in terms of the pipeline, I think we looked at properly. I saw about 200 of those. And off of those 5-minute skims to see the businesses that we like. Like, I'm not very interested in what I call spin the wheel businesses now. So we're going to be the next Snapchat. We're going to be the next Airbnb. To me, I think those industries have been saturated and commoditized. And so it's more of a game of luck and skill. I'm looking for other niche businesses. I'm trying to look more for B2B businesses, SaaS. Those are some of the ones I'm starting to enjoy to invest in a little bit more. I'm not saying I won't look at others, but that's kind of how I do that and weed it out. And from those 200, weed it down and eventually end up investing in 14.
okay. And when looking at those deals, so you mentioned a few, but like say it's made your screen criteria and now you're doing the deep dive. What are sort of some common deal breakers, and then what are some more like weird deal breakers that you've come across?
Some deal breakers is first the entrepreneur. So I always sit down and I consider myself a people person. That's the background I am. I invest and work with people, and then I usually get people with industry expertise to come look at the project with me. So if it's a SaaS business, I've got a couple early stage VC seed companies I have look at it. If it's and being from a search business, I'm lucky because I've got a good network. I hope that I've got someone in almost every single type of business line that I'm going to see. So that's typically, pitfalls I see from entrepreneurs is over exaggeration. The best one I typically see is when they want to raise and they send me their deck from, and then 6 months later I see them again and I look at their old deck to see if they hit their numbers and the deck's changed. And it hasn't, but now they've got new growth numbers that are even larger. So that truth lies as you watch, objectivity, I keep every single pitch deck that is sent to me. It's filed away in a CRM database. I treat it like if you're in recruitment, you have candidate databases, I treat pitch decks the same way. And I go back and I see what people are doing. So I can always tell and check. It's like a VC model, I guess, in terms of seeing what's happening. So that's a good criteria scheme. But usually when I sit down and I'm first talking to a company, I'm just having a chat with the entrepreneur. I want to know about them. I want to know why they're in the business. I want to know that they're passionate about the business, but not the specific idea itself, because it's very tough to tell someone their baby's ugly, but the industry might still be a good industry to be in, right? So I want to make sure that they're not fixed to an idea, but they're fixed to maybe the industry, because that's the space that they want to be in, right? Once I see those things, then I'm typically investing and I'll look. There's a great article out that I read which talks about types of investors. I call myself a sponge investor. And so I'm the investor that goes out, takes all these different things that I see, the entrepreneur, my industry experts, thoughts on the businesses, the market size, growth, my thoughts on the business, etc., my time, size of check, valuation, and I come up with an answer. And so part of that is, I'd say, is a little bit of gut, but most of that is based on these criteria around. There's other investors who are actually researched to be the best type of investors, but I just find it way too boring, is to have a checklist of every specific thing that they're going to do. That's a really smart way of doing it, especially when you're going to start off. As an angel investor, is to have a checklist of, do they hit this target? Do they have this team? Do they have this revenue? Do they have X, 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 X? And that's the two types that seem to be the most successful. So I fall into the previous, not the latter.
Sponge.
The sponge. That's typically my investment thesis. It's the sponge. And so it's taking all those facts, but it's based on a variety of reference points that I'm looking at to come to that conclusion of what I'm going to invest in. So arrogant, entrepreneur, I don't invest. There's a couple actually in Vancouver who were doing very well, but just because of their personalities, I decided I wasn't going to invest. And that's just because I want to enjoy the people I'm working with as well. As an angel investor, a lot of individuals here are, you probably spent the time working with ones who aren't as enjoyable. The investments you have, you at least want them to be fun, and you want to enjoy talking with those individuals. And so, that's kind of the pieces that I'm all looking at when
Yeah, it's interesting. I've raised venture capital before, and so down in Silicon Valley, meeting with the VCs, and they're taking a bunch of notes, and then you fly down a couple months later, and the first thing they do is they bring up your file, and they kind of quickly skim it over and ask you a bunch of questions on what you'd said 2 months ago. And it's kind of like, oh, what did I say 2 months ago? I hope, I was like, oh, did I say this? So moral dilemmas as an angel investor. So one is you have this keen entrepreneur. They're really focused, spend all this time, really invest in their idea, but you're in your mind, you're like, you've seen a lot of deals, and you're like, this, he's not going to raise money. This isn't a good deal. But you want to be encouraging, and you don't want to like tell maybe a third of the entrepreneurs that pitch you like, no, don't do it, okay. So that's part one of the moral dilemma question, which is not on the list. I'm just ad-libbing. And the second one is you want to encourage entrepreneurship and startups and tech, but you're saying no, like 20 no's to every yes, and isn't that a bit negative on these guys too? So how do you kind of manage that?
So the first thing I tell entrepreneurs, and I chat with everyone about this, and by the way, I just want to preface, I usually say this at the beginning, the way I invest works for me because of my background, my experience, my knowledge. Where I've learned to invest is to take tidbits from a variety of angel investors. And so all the stuff I'm talking about would work if you're going to speak to me, but if you go to Silicon Valley, or you go to Singapore, or you go to London, and I've invested globally in these places, every angel investor is different, the culture, the feeling, and how they operate is different. Just take that into account as if there's entrepreneurs in the room or as angel investors working. The first thing is I don't have difficulty saying no, because for me, it's not that I'm saying their idea is bad, it's just not for me, right? So I talk to entrepreneurs about this all the time, is that there are people who didn't invest in Facebook, right? There are people who didn't invest in LinkedIn and Snapchat, etc. You just don't know sometimes, and the risk and the variety is so high. And so I'm not trying to say your idea sucks. I'm just saying, for me, it's not fitting my criteria of what I want. And I'm always there for advice, right? I'm happy to provide advice, and if they ask for advice, then I will say, I don't know if your business is viable because of these reasons. However, if you can solve these reasons, you might have something there. Or chat with these individuals that have that experience. So, in that moral dilemma, I don't find that as much of a moral dilemma, because I'd rather get to know fast. That's my personal opinion. Like, if I start a business and it's really horrible, I'd rather have everybody tell me it's horrible so I can go do something else, versus wasting a bunch of time saying I'm going to prove everybody wrong, right? And so, I think that's the key on that. I don't find that as a moral dilemma, and I think it's actually part of just the investment process. Your second question was on the dilemma side?
Well, it's just you're saying no a lot more than saying yes. How do you like?
Well, if I said yes more than I said no, I wouldn't have more money to invest.
Yeah.
That's just a numbers game. So you have to say no on a lot of projects. But that doesn't mean someone else might not write checks into it. Right? There's so many different sources, like angels. They call it angel investing because there used to be this gap between VCs and early startups. Now you're starting to get equity crowdfunding, crowdfunding businesses that are not taking over. In fact, there's one company in Vancouver that couldn't raise a dime off in angels, but raised it all through equity crowdfunding, and then went and wrote an article bashing all the angels because, hey, we got through crowdfunding. You guys don't know what you're doing. Perhaps not, right? But they were able to get traction built out. And now they probably could have somebody invest. So there's starting to be other pieces that are filling these gaps and other ways that you can build validation, because it used to be only angel investors that could do that for VC firms. But now you've got grants, you have crowdfunding, you've got a variety of other tools and systems that you can use.
And one note is, I think it was Kevin Rose did some research and said the average angel sees 40 deals and invests in one. And so as an entrepreneur, like raising money from angels, like you just got to be talking to a lot of people and like think of it as a sales funnel and really work it that way.
Is there a lot of entrepreneurs in the room right now?
Entrepreneur who?
How many entrepreneurs are there? Okay, great. Just a couple things I would say really quickly on that is, it's great to go see as many angels as you want, but really go do your research on the angels you're seeing. And what I mean by that is that right on my, actually I need to put this on my LinkedIn. I'm going to put right on my LinkedIn what my new investment criteria, what my investment criteria is. And I say it in all my speeches. Anytime I talk, I say exactly what it is. So it's not going to help you to come to me and chat about a business that's at Series A, you want to close it, you want me to help, and it's at 10 million valuation. Like, I'll come sit with you and talk, potentially, but your time is much more valuable spent. And when you do get to that round where you're going to raise and build out, I actually got this, I was out down in Silicon Valley with Sequoia and Andreessen Horowitz, and they were chatting, they said, man, the biggest problem we see with entrepreneurs is they come down, they do a roadshow, right? They come down, they talk to 8 to 10 firms. They go, the best way to do it is to actually go down, and if you have a list of 8 firms, go to the ones you don't care about at the beginning. Do 2, go back home, refocus your pitch, go back down and do another 2. Now this is now your 7th and 6th ones, most important. By the time you get to your top 2, your pitch is perfect or refined to a point where you know that you've got the best chance of getting the money. Okay? It's the same thing I do sometimes when I'm practicing on different projects, etc. So as entrepreneurs, make sure you get a chance to do that. Don't do it all at one time because it allows you to kind of refine, refocus. And out of the first couple of VCs, you might think, oh, this business we don't have solved, or hey, we're missing some advisors. Let's get those done before we go meet with the Sequoias and the Andreessens and the larger firms that we want to have in this fund. That's just a little tidbit of something that I've seen from a lot of people.
So how do you work with other angels and like syndicate, and do you lead or do you follow, and do you work with any funds as well, and how do you sort of network and manage that?
Yeah, so I'm loosely in a couple of angel groups, but I've never invested in one together. Simple reason for that is I think I have enough deal flow, and I syndicate most of my deals. So, I've given you the example of, I think when we were chatting, was that my job and what I do is I try to evaluate the people and a bit of the business and market. Then I get people around me who are involved in those type of businesses and industries to come in and invest with me in those companies. I'm happy to lead, and I'm happy to follow. So we just did a deal right now, a company that's based in my office that was working. I said, hey man, we want you in this company. It's a SaaS business that actually is like dental software, optimization softwares. And they were like, we're targeting dental labs and clinics and private equity firms. I was like, oh, hey, by the way, I did a search for the CEO of the largest private equity dental clinic. Would that be helpful? They got about 200. Like, oh, that'd be great. I said, okay. Well, before I do that, I want to introduce you to these guys who specialize in SaaS and health tech. They're guys I really respect. Here's another guy who's worked at a dental lab. He was a CFO. I wanted to vet, and I've got a technical guy that wants to check out your project. So I got those 3 people to look at it. The SaaS kind of early stage VC firms like, Manny, we want to take more of this round. Do you mind cutting yourself down? I said, hey, go ahead. It's a 300K round, small. I was going to do 150. What do you guys want? They said, we want 150. I said, okay, well, you guys take 150. I'll do 50, 50, 50. And the 4 of us ended up coming in on that deal together, right? Because it's what we're doing is putting as much smart money around us as possible. Now they want introduction and relationship to open doors. I can do that, right? They want experience on optimizing software and SaaS business and growing and scaling. That's what that other funds are for. They want other relationships in the US. That's what the other person brought in there for. And so for me, it's bringing that pie and building it far enough because you're diversifying within that business itself, but not bringing too many angels in. Too many times, like, I will not invest in a round that has more than 5 people, right? Especially if it's lower than $500,000. And the reason for that, Mark's looking at me right now, the reason for that is that I always want to keep it simple. Like, people have asked me, and I think this is a question you have, Manny, what do you ask for on your term sheets? Like, what do you want?
That was my next question.
So what do you want in your deals? And people are like, oh, do you ask for ratchets? Do you ask for et cetera, this, that, that? I ask for none of that. I typically ask for 3 things. Information rights, pro rata rights, and if it's a note or safe, the option to convert to preferred shares. Those are the only 3 things I care about. And the reason for that is that, and I'm probably jumping on tangents here, but the reason for that I ask is because I had a situation with a company where the board directors, in my opinion, were doing some interesting things. There was a loan out for 50%. The corporate governance was falling and I just said, listen, I want the information, and as a shareholder, allow that information. And I triggered an audit, right? Because I was like, there's interesting things happening here. So those are the only 3 things I care about. And what happens is if you put ratchets, if you put all these other things, people are trying to get so creative. I think sometimes as angel investors, we get so caught up that we're so smart, we're going to build these creative structures. Well, guess what's going to happen? When the VC firm comes around and says, we're going to put money in now, we're taking out all your stuff. Right? And you have a choice. Either this business gets funded or it doesn't. You're going to get rid of it anyways. Right? And for me, it's that positive relationship you're building at the beginning. So the 3 things, like I said, information rights, pro rata into the next rounds, and option to convert to preferred shares when they happen. Those are the only 3 things that anyone investing after you should not care about. But for you are very huge and important going forward as an angel investor.
For information rates, is it can you unpack that? Is the ability to audit, or is it monthlies or quarterlies?
Well,
or
audit is
what?
anything in BC. Mark, can you describe this? Audit is anything, any individual BC who's an investor has the right to request an audit, correct?
Absolutely.
Oh.
Perfect. See, that's what Mark's here. He can answer all the questions. Information is like, and this is just through experience. Like I've noticed the companies that are typically the best are the ones that provide the more info. The ones that don't provide info are the ones that are struggling and actually need the help more, right? The ones that I don't hear from for 6, 8, 9 months, they're the ones that are on the rocks that afterwards I go, hey guys, girls, why didn't you talk to me like in month 3? We could have helped you. You were out, you needed a bridge loan. Well, here we could have done that. You needed, you needed help finding people, or one of the things didn't work. Well, let's sit down. Like that's our job as an angel investor. So information rights that I look for are typically like quarterly financial statements now. Typically on any big decisions. Sometimes I'll even ask for if it's any large expenditures over like $100,000 or $250,000. But typically it's the quarterly financials now because I can learn a lot from those, especially if I'm not getting them, and at least a quarterly update of what's happening with the business. Those are the basic information rights I'm asking for. And then depending if it's mobile gaming, you might ask for other conversion rates, etc. that end up in the statements. But that's what I'm asking for.
So one theme I'm picking up from you is the coachability and the collaboration. And so I think a lot of young entrepreneurs think they have to be the man or the woman and going to take over the world. Here's how awesome it is. But you're more looking for you're looking for a great business, but someone who shares the issues and brings you in to get feedback and help and that kind of stuff.
Absolutely. So what, as you're building your business, the thing that I always say is you know more about your business than I do, right? So for Wave, for example, right?
Yes.
So, for Wave's business, for example, you obviously know what you know more than I do. However, I've probably got some experiences, maybe in an unrelated field or industry that can help you build and have your advice and develop on. Now take them and do what you want. I'm not going to get upset if you lose your business or the business fails because of business reasons. If it fails because of corporate governance or other reasons, that will upset me. But for the other stuff, I don't care as much. Now, use that advice and move forward because it's going to be a relationship, right? If I'm an investor in a Wave's business, I'm supposed to be smart money. I'm supposed to be the positive relationship. Let the VC come in and hammer with them and have a negative relationship, but I'm there backing them up and working with them, right? But for me, you want to keep that positivity around. I was on a panel last week with a couple of individuals. One person said, in a negotiation, both sides should come up feeling a little negative. And I was like, why? Right? This was actually a panel I was at, and I was like, that doesn't make any sense. I go, at the VC level, sure. Right? They deal with big firms and you have issues, but as an angel, I want to come in and say, here's what I'm looking for. If it doesn't work for you, I completely understand. And I'm not going to negotiate, try and knock your valuation down from 2.2 to 2. Right? That's not my goal. It's to be more like, hey, are they kind of around the level of what I'm expecting it to be, and then invest in the person. Because it's got to be a positive relationship. There's got to be a level of trust. As I said, I'm betting on the jockey, not the horse. So I have to have a level of trust with that entrepreneur that they're going to take advice from other individuals, and then be able to go make a decision that they think is best for their business. Because they're in the day-to-day of their business. I'm not. Right? It's really easy to coach from 30,000 feet up. It's really easy to guide a business from up there. But Wade's the individual who's got to build that business and make the strategic decisions. And we want him making those decisions, not myself and not any of the other investors, because he's the one that has to live with the ramification of that decision. For me, it's an investment, right? And I've got a variety of others. For him, it's his day-to-day business, it's his livelihood, it's his passion. He could have student loans out, he could have a variety of things. He's going to have to wear it.
Tessa.
Thank you. Oh, I can talk pretty loud. I'm really interested in how you're talking about the working relationship with an angel investor, because can everyone hear me?
Mm-hmm.
Okay. I've just got my first 2 investors, and I don't know quite what to do with the situation. Like, they're really great guys, but it's like, do I reach out and get advice from them, or are they like, you know what, I just invested, just you do what you do, I'm running my company. So you're saying, because you put angel investor and the word coach together, and that's kind of exciting to me, but is that just you as an investor, or is that what an entrepreneur would hope for an investor?
You on the way?
So can I ask a quick question? Everyone raise your hand if you're an angel investor. Okay. Who typically as an angel investor invests in business or ideas or an industry that they know fairly well?
Try.
So do you think it might be a good idea to get expertise from you guys as angel investors? If you guys have some expertise in the business and idea, coachability is probably something you want to be able to give up in terms of doing. So the first question I ask is ask them.
Yeah,
Right?
you don't want
If you
to.
don't ask, you don't. But secondly, typically angel investors are people who have some sort of strength that they can give to you. I always say your first checks in, unless it's debt or grants, should not be just money, it should be smart money. It should be individuals who can accelerate your company. It should be individuals who can open up doors, teach you some things that hopefully help you get to that certain platform, that certain level for your next raise faster with less problems. And that's the goal. And at least for me, and I'm not sure the other angels, if I write you a check, I don't want you to say, go ahead and let's see what happens in 10 years, I'll see you. It's, hey, you just took some of my money. What's going on? Right? I'd like to know. But it also depends on the angel, right?
Yeah.
That you're working with. And I think that's the key, is to get that sense. But to me, anything that's dilutive capital at the first round, maybe other than friends and family, we'll call it, that's fine. I'll say after friends and family, if you have friends and family around, should be smart money. Should be individuals who can help open doors for you. It should be an interview process back and forth when you're looking to talk to investors. Yes?
I mean, because I've been wanting to ask this question, it's right along this line. So how watchful and involved are you with your companies?
It depends on the company. I am all the way from board director on a couple of them to a few of them. I just get the updates and I touch base a few times a year. So what I typically do is when I first invest, I say, where can I help? And here's where I think I can help you out. Here's some relationships, here's some networks, here's contacts, here's where we can go. Reach out to me anytime, because I'm able to reach out anytime at work. And then if I'm not hearing from them, I definitely reach out. And I want to see what's going on. Or if I think they're going on the wrong path, I'll have that chat with them. In terms of, for example, there's one company I was working with where I was insisting to get a board director for the last 16 months because I was worried about the organization. 16 months. And it was until 16 months that I finally said, okay guys, enough's enough, we need to figure something out. But to me, it's the reason I'm not, if I ever written a $5 million check in that company, I'd probably be watching it a little bit more, but I'm making a lot of small bets. I'm not the spray and pray, but I'm also not that active. I'm somewhere in the middle, and it depends on the business and where people want my help. Yes, Angela.
What's your kind of typical bite size and then your overall budget? And I kind of have a backup question after that.
Uh-oh, that's scary. Let me drink some wine. Okay. So my typical check size in early stage companies now is about 50 to 100K. That's my seed. And then I'll follow on if it's debt. I'll do up to $500,000 in bridge financing on SHRED, government grants, IRAP, etc. And I give discounted rates of these companies that I've invested in to do that. My total portfolio right now, you can calculate it out, but yeah, it's average. I think the average check last was 80 in terms of the seed. And this is seed level, so this is all pre-500. So I typically end up taking 10 to 20% of the round.
Okay. And then how often do you exercise your pro rata during tough times? Is it pretty early?
Yeah, well, it's not just during tough times. It's during good times too. Depends on the business. Depends on where it's at. I don't have a specific number, but I know I have done it. So it's not like I've done it once or twice. I'd say there's probably been about, at least 10 or 12 businesses that have flamed out. And some you just can't save, right? But I'll always throw some money in the end if we think it's worth saving. But I'm a big believer, I might have slept through my Econ 103 class, but I remember some costs. Okay? So, I don't chase good money after bad money. I learned that the hard way. I lost about $350,000 in a company because I invested $100,000, then I loaned them $150,000, and then I gave them another loan of $100,000. And I was chasing bad money. I should have just cut off that first $100,000. That $250,000 could be my kid's education fund, and I'd be good to go. Right? So I've kind of learned from that as well now. But it's a sunk cost. My investment is now done. I'm there to advise, I'm there to work with you, and I will follow on. I will help if needed. Like if you need to close around, etc., follow on. So I will come and write that last check for you if you needed it, especially if I was the lead in the first one, or if you need to talk to people why I'm investing in the company and doing it. Because a lot of times people will ask to speak with me because they know I'm intimately involved. Sometimes a lot of the companies that I'm with. But it's I can find the exact number and give it to you if you like later. Okay. But yeah, I'd say sometimes.
Valuation. So you said 5 million's your top, but underneath that, how do you think about valuation? And then Wei comes up to you and he thinks he just started and he thinks he's worth 4 million. And how do you have those types of conversations?
I think this is really interesting. I actually teach a class. In the class at SFU, I teach is resourcing new ventures. And one class we have entirely is devoted to valuations. And I always put that class at the end of the semester. And the reason I put it at the end of the semester is I tell every student, if I do this class first, you will think I have no idea about business whatsoever. And the reason for that is that pre-5 million, the reason I'm playing in that space is because I want to get to the real risky projects. For me, a company going from 2 to 20 million from an investor's perspective and a return is the same thing as a company going from 20 to 200 million. And then it's the same as it going from 200 million to 2 billion in terms of the return that you get on your capital. And so Canada historically and has been companies that usually exit at lower valuations than they would in other parts of the world, in the US, etc. And I see a lot of exits happening pre-100 million. So I want to get in earlier so I can see still. Because in angel investment, you want to hit 10, 20, 30 bags. That's like minimum. That's what you want to see. If I get an investment back that returned me 3 times my money, I'm not jumping up and down for that, right? Because that's not what I'm investing in. That's not the risk profile of this sector and this target group. So in terms of the investments, sorry, can you repeat the question really quickly?
Oh, no, I can't.
Valuation.
Valuation.
I get confused.
Yeah.
So really, it's an art, not a science, right? The valuation is not art, not science. Now, the one thing for entrepreneurs is do not go into a room and just say, these guys raised this at X last year, so we think we're about the same. Because you're not the same business. And even if it's the same company, etc. That's typically what most people come to me at. And what the interesting thing is, when you have to define your valuation at this level, it really tells you a lot about the individual and what they think and what they operate like. And so if someone comes to me and they've got an idea that hasn't developed, they have a track record that's like, we're worth 4 million, I'm not going to invest. And more than likely, if you come back to me later, I'm still not going to invest. But if you walk to me and you give me a credible solution or credible assumptions, saying, listen, we've just built it, we've got 1,000 users we're testing, but the market we're in, the industry is high growth, we think that we're hitting early adopters and it's going to build going forward. We see some competitors in the space, here's some valuations we're seeing, partnerships. It's not just one partner we depend on, but there's a variety, so we're not beholden to one individual. Here's our sales channels, and you can walk me through all those different types of things. Once again, I have an article that actually I saw that I use in my class that I built that goes through all these different types of levels. There's about 7 or 8. Through that, we came to a valuation of this. Then you're not going to hear me argue between 2 and 2.5. However, if you walk up to me and say, my valuation is 4 million because we're in a space, for example, and this company just raised 7 million at this valuation, then I'm going to say, well, okay, I think you're at 2, you think you're at 4. How are we going to bridge that gap? Right? So it's the more information you walk in about your business and the more data you can have, even if it's lateral. Think laterally here, right? Think laterally about your company. Think about the different things that you can use. Use that as your backstop. And I can guarantee you the more of those pieces you bring in, the less arguments you'll have on valuation. Because that's when I shut up usually. Right? If someone walks in and says, because to me that also means that, okay, this person's done their research, they're going to be this detailed with everything they do now going forward. And so if at this early stage where the tolerance for ambiguity has to be super high, what's going to happen as they build and grow forward? Now when they sit in front of a VC and they actually have real data, I can't wait to see that.
Can you share a little bit about some of your angel investment successes and I don't know, exits or companies that are really doing well?
Sure. So I can talk last year, probably. So last year we had a few pretty good exits, and I had a few pretty good exits happen. One was MTT. It's a really cool company, actually. We ended up, and this is why for each of us, was I say, go out, meet, chat people, because I would have never seen this company. It would never been a space I would have ever invested in my life. They were building projector screens that were like 100 to 1,000 times more, I want to say nicer, that's definitely not the right word right now, but they're clear quality picture, etc. what was out currently. It was a hardware company. I know, I said I wouldn't invest in hardware companies, but I got convinced by somebody who was in the field to take a look at it, who I really respected, and I saw the entrepreneurs, and they were all engineers, and I was like, oh, if I could put a marketing person and a business person on them, they're going to kick butt. So I ended up writing a small check. Then one of my individuals I invest in, I wrote a 25K check. It was just a flyer because it wasn't The other individual came in, he looks at me and goes, double your investment. I go, okay, sure. I trust you, I'll double it. Why? He goes, because this technology is great. They just won a competition on Silicon Valley. They're going to get taken up, et cetera, acquired. That company ended up, it's confidential on the acquisition in terms of what happened, but it got acquired by Banro Corp. And so in 1 year, we had a multiple higher than 5x exit on that business. I can't say the exact ones and the numbers because they are confidential. So that was one. The other one was we were invested in a company called Fantasy 6. Came out of an incubator accelerator in Vancouver. I was the first investor in the company, founding investor along with another individual, and I put up $250,000 or so into that company, and that company exited, went public, and I ended up owning about 7 million shares, public trade. The company's valued at about $100 million right now of the organization. So that was a really good exit that happened last year. We had a mobile gaming company that I actually ended up developing and building. That's a little bit tougher to do because we sold it and ended up with a royalty share, about 35% of the gaming when it proceeds and builds out, and exited about 20% multiple for our investors, which was 14 months. So that was pretty good. So that was some of the good ones. I've had a lot of bad
Well, that's the next question. Horror stories. So you shared one, but do you have a crazy one?
That one I can talk about for hours, though. That was more one.
Yeah.
And so, that one was, so we lost $350,000 on that. There's been a lot of early checks I've written where the companies just turned into lifestyle businesses. So it's where you think you're building a scalable idea, and then all of a sudden it's not very scalable, but it ends up spitting out a lot of good cash flow. I've had a lot of those businesses. Some I've just written off and said, hey, enjoy the donation. Others, they help us get our principal back on. If it's like that and they build a lifestyle business, I'm not asking for a massive return. I said, can I get my principal out the next year or so, please? And then we've had a lot of 25K check drops like that. I put in really super early stage companies, and I was like, hey, I just like the entrepreneur. I think it's interesting what they're doing, and in 6 months the company's flat. But the really big one that I had was that large one, right? It's always been, my biggest check losses have been where I've thrown good money after bad money. It's where I'm like, this could work, and if I put 100K in, if I just put another 30K in, I think they're gonna make it all back. And then it's gonna go, and or another 50K, and it's only half of what I put in before. And so those are the pitfalls with a lot of angels. We get emotionally attached to some of our businesses, or some of the entrepreneurs. Like, I become friends with some of the entrepreneurs I work with. I'd say, but those are the ones. And then there's some exciting ones coming up right now. The Pick Tick's a really cool one in Vancouver that's disrupting the space. They're break even. Jayesh is building out. He's an awesome entrepreneur. I've invested in for 3 years. He's pivoted, learned the model, and now he only goes into negative when they need to hire more people and build up, which is actually what you want to put your money into growth. So that's interesting. And then a lot of the companies now that I'm seeing are moving into Series A rounds, which I'm very interested in. So my best helper is one of those, which Mark's helping us out with, and a few others now in Vancouver. The ones overseas that I invest in, so I've got investments in London, Singapore. I guess the USA is not overseas, but we'll technically there's an ocean right now between us. But those ones I kind of have less control over. So those are the ones I'm taking real flyers on and keeping in touch with funds that I've syndicated and invested with to manage those. A lot of those have disappeared, but those have been just expectations of the VC model that I see.
Can I ask a question?
Yeah.
So the companies where it turns into a lifestyle business is a common outcome, I guess, with angel investing. Is there ever the opportunity to add a clause where if the company starts missing milestones that it converts into a revenue-based financing arrangement?
That's a good
where,
question.
the company's now returning a lot of revenue, so you can start getting your return by skimming a bit of that revenue instead of just losing the equity. So there won't be the exit.
So I've never done that. I'll be honest, and I would never do that because then I'm expecting them to become a lifestyle business, and that's not why I invested in the company.
It's just safeguarding against, not expecting.
It is safeguarding, and there's a couple of agreements you can use. There's so Y Combinator started the SAFE. 5-year startup started the KISS, which has like an end date on it. It's simpler than a convertible note, but it's got an end date when the money matures, and then you can either roll the money over or the money's due. So you can do an agreement like that if you like. But
That's
yeah.
fair, but it's still like,
Yeah, and here's the thing, entrepreneurs worry that they have lifestyle business. I have a lifestyle business. My search business is a lifestyle business, right? Like, it's awesome. I love lifestyle business, especially if it's yourself. But you hope that you invested in an individual, at least I do, that I built a relationship that I trust, that they're not going to want to keep me in that business. Now you've just got small shareholders in a business that's yours. That can get more irritating than having a clause trying to get them out of it, right? They trigger an audit on you every year. You have to hold an AGM, right? After a while, if you've got revenue coming out, you can negotiate a good deal, like 5% of revenues go out to pay out investors and you're paying their principal back. The investors are probably happy because they get the principal back. And you're probably happy because if this is after 5 years, you said interest-free 5-year loan, right? So I think there's always a middle ground you can play with there with an entrepreneur, unless they really want to keep your money. But on a 25, 50K check, if it's a lifestyle business and it's doing really, really, really well, why would they not want to get that money out? And like I said, it goes back to my first point, keep it simple, right? 3 things I ask for, and that's what I ask for in every agreement that I work with now, because it allows you to keep that going. But as soon as you start putting these other tweaks in, and not saying you shouldn't, like I said, everyone, doing their done. Just for me, it does. To me, I'm almost trying to hedge my bets. And in this space, in the angel investment space, I'm not really hedging.
Man, I'm just kind of puzzled. 25 grand. I mean, what's the expectation of that to help a company? 25, 50 grand. That's going to pay the legal bill. I mean, what?
Well, these are
Not if you have Mark Longo.
yeah. So like I said, those are the small checks that I'm writing, and if it's a flyer I'm throwing in a company, it's coming in. I'm not throwing a 25K check in as a lead, right? If I'm writing a lead check in, it's usually, like I said, 20 to 30% of the round at least to get the round complete. If it's under $500,000, then I'm throwing in 100K usually, maybe 150 on unique occasions, but usually my check size is 50 to 100K. And so it's seed, early stage.
Are you looking like is that an HR place so the guy can, the company can hire a tech person or a sales team?
It's that they can test out that first 300 to 500K for all the entrepreneurs in the room. They learn to leverage that very quickly, and then they can hire a tech person. They IRAP and shred them, and so they're only paying 20%, right? And then they EBC to the angel. And usually what I do is if I get EBC, I just throw that amount back on top of the investment. So for them, they're actually getting another 30% out of me. So 25, 50K on its own is not going to do much, but I'm not coming in writing that one check, right? I'm expecting that they're doing a round. And even if it's $250,000, $300,000, $500,000 round, right? I want them to have a few other people in the space. Not too many, but a few. But yeah, writing a 25K check into a company is probably the worst thing that you could do, especially if you're the only check.
Just a quick time check. Do we have like 20 minutes left or 5 minutes or?
7:22.
I can't do the math. Okay, so we got a bit of time. Cool.
So you see a lot of deals. Do you, when you're looking at really high potential entrepreneurs, high potential companies, do you earmark a segment of your portfolio where you do want to follow on at the A round when the VCs come to the table?
It depends on the VC, but I will follow on. There's a couple times. One thing I do sometimes, which is interesting, is I see a really, really, really good entrepreneur. Like I'll name one, and I'm sure he'll be okay in this. Daniel Dubois. Daniel started ShareShake, which is an outdoor marketplace or a community marketplace for outdoor equipment. I'm not a big fan of the idea, right? I wrote him a check and I said, I'm writing this check with the provision that your next startup you do, I get access into that deal, right? Because I want your next deal for sure. And so that's typically what I see. Now with coming on with VCs and following rounds, if I'm gonna do that, a lot of times what I'll do is I bridge. So the client needs money and they're investing, and for them to go to a larger firm where you do shared government grants or whatever, they're paying a 30-40% interest rate sometimes for these things. I'll come in and I'll say, listen, you need 6 months for money, I'll loan you up to $500,000. Interest rates 10 to 12%, and I'll take some options. That allows them to go raise their funds without any worries. Allows me to get a little bit more incentive to the organization, but then no VC can kind of take advantage of them. And then sometimes what I do is I roll in a portion of that into the actual investment, right? So I'll take the interest, I roll it in, I take a portion of that equity, I roll it in, and that's what I'll do. But I'm never setting up my round that I'm going to come in and follow on for sure when a VC comes in.
Oh,
Yeah, it might sound like a bit of a silly question, but sometimes the round may be unrealistic, right? So the valuation is fine, but you guys want to do this with 300,000. Does that happen sometimes?
Yeah, I would say most of the time I'm always asking for a larger round. And the reason for that is, I always joke around that South American companies, Asian companies tend to get to revenue faster. It's just something we've seen, whether it's just the culture, etc. Where in North America, we really love this word called pivot. right? We pivoted our business. We're doing this, which really means, this didn't work. But we just don't say this didn't work, right? And so at that early stage, that early level, you need to have a little bit of wiggle room with your money. You can't be going after just one idea. Like if you're, in the mobile gaming space, for example, you need to have some money where you can try different types of ads, different types of traffic, etc., affiliate marketing to figure out what's going to work. So usually we ask them to bump the round up a little bit and then bring in some individuals around it. But sometimes they want to do equity and debt. A lot of our entrepreneurs don't want to give up that much equity at the beginning, right? Because valuation is lower, right? Raising around $1 million at 10 million valuation is very different than doing that early on. 100 grand at $1 million or 200 grand at 2. And so we typically ask for that. So it's either an early bridge round with a follow that they'll ask, or we'll ask that they raise the round. We typically do see that quite a lot. Yeah, Stephanie?
Oh, no, I was just 5 minutes.
5 minutes.
Oh, 5 minutes?
Yeah.
Okay, I only have 2 more questions, but these questions are better. but I do have filler. Okay, I'll ask one.
Yeah, sure.
So, not to pick on Wei, young entrepreneur guy, wants to raise some money, goes to the web, reads blogs, Quora, YouTube, and a lot of the advice is like, you gotta have this really good elevator pitch, or here's how to have this perfect slide deck and have this in and this and that and stuff. And so how important is having that good quality or polished, and what are your thoughts on that?
I think the key is a polished deck is great. You can get all that information. The key is a solid understanding of your business and what you want to do and why you're doing it. And when you go to an angel investor, I see John's name tag there, so I can say John. For me, I think a lot of the checks that I write happen when the entrepreneur doesn't ask me for money, but they come for advice first. And as soon as they come for advice, John, I don't know if you agree with that. As soon as they come for advice, I no longer care about your pitch deck. I no longer care how shiny it is. I no longer care you have that dumb hockey stick graph or that 4 quadrant where you say you're the best and everyone else is horrible, right? Because we're going to have that conversation. So, I've noticed that when people come to me and ask for that money first, you have an expectation of what they have and what they've completed. Whereas when you come for advice, a lot of angel investors are happy to provide and give you some thoughts and guidance on what you can do. So when you come back the second time, they go, hey, that's kind of an interesting idea. And the other thing they do is when you ask for advice, they open their doors up to other individuals who might be interested in investing in that type of business or can provide you some advice. The beauty of being young and a student is people want to help you. It's like when you graduate, they don't care as much, right? Once first year out of school and you get your first job, we don't want to talk to that 1-year-old at Detroit or the first year out of Deloitte background. We want to talk to the 3rd-year student who's in entrepreneurship because they're doing things as a student. And so leverage that, right? Build that and use that to your advantage. And even with any seasoned angel investor, it's worth having that conversation and asking, and it's worth doing a little bit of that digging and research in the background, right? So when you're going to meet with John or myself or James if he's investing in a business, find out what we enjoy and find out why you want to chat. Say, hey, I noticed that you would invest in this type of company. I think my company has some similarities to that. Do you agree, disagree? What do you think? Any learnings I can take out of that? And I can guarantee you your chat's going to end up being longer than if you schedule half an hour. Might end up getting a little longer. John, would you agree?
Absolutely.
Right, in terms of...
It's a way of engaging them and getting to know them and helping them see how well you interact. And then you invest.
Exactly.
My last question is a little bit of a geeky question. So what kind of tech do you use to help you in your angel investing? So there's like Gust and AngelList, different like crowd investing platforms, or like there's Hockey Stick for like tracking metrics and cap table stuff, or like what, or is it just like Excel and Google Docs, or what?
So we've got a couple databases. So NACO, who I work with fairly closely, uses Hockey Stick, I believe. My research be correct, just remember, where they take all the data and put everything in, we input all the companies we're investing in. So that's really helpful because it's a tool. And then what we've done is I've taken a recruitment database and I've had some developers tweak it, which tracks every single company that we've met. So when someone meets me and they say, hey Manny, we're interested in chatting with you, here's our pitch deck, that gets flipped into the system with that note, and that's there. I'm a very unorganized person in life. My wife's probably the first to admit it, but for some reason my inbox is the most organized. There's never more than 3 to 5 emails in there at a time. I've got so many folders of every single company that's met with me, etc. So I'm pretty good at that and keeping those things there. But I think that probably comes down to the search background, right? Where we're doing these searches and you had to manage hundreds of people's names and your backgrounds, and someone called you, you'd have to, before they answered, look up who they were, right? And so it's a similar thing with the decks of companies and businesses. I'm sure, I've been doing this for 6-7 years, I'm sure when I get to 20, a lot of that old material will be gone. But that's typically how we manage it. Gust, I've heard very good things about. They do that as well. On a sales side, if I'm working with angel investors, I track that in a different database called Pipedrive, which is actually like a sales lead company that we use. So I actually have like syndicates. So there's 20, 30 people I talk to about SaaS businesses, social impact. There's 10 or 15 people that I'll flip the deal to. Each vertical that I'm in, I've got individuals that I send the deal to. So it's kind of like its own mini database.
You have funnels set up in Pipedrive?
Yeah, so it's funnels on like, but it's not like stages. It's like the funnels are on the deal. So if the deal I actually like, then it goes into Pipedrive and it goes through the different pieces. And then my Donna, we'll call her, she helps me manage that pipeline. And then every quarter I kind of just take a flip through them and which ones we're gonna go with. I say no a lot more now because I used to have an associate and an analyst, and I had a few people working on it now, which is much easier to manage. Now I decided I don't want that model. I may hire one person underneath me, but to keep investing 14, 18 companies a year, I would end up going insane in terms of companies if I was going to manage it. So the investment's gone down. I'm probably going to do 6 to 8 a year, 6 to 10, but keep it manageable.
I'm question out. Any final questions?
I got one over here.
Yeah.
You say you look at a lot of companies before they have traction. So what are some of the key metrics you're looking at if they don't have traction yet?
How close are they? Sorry, there's a microphone here. How close are they in terms of if they've got a beta out? What's the different types of avenues they're trying to get traction? So have they figured out 3, 4, 5 different spokes that they want? And what's the amount of money they're going to raise? What's that amount of money going to take them to so that they can get their valuation up to the next level, right? Those are the ones that we're writing some smaller checks in to see if that business has some traction or can work or they find something. Then we write a quick follow-on check for it as well so they can continue to grow and develop. But those are a lot more bets on the entrepreneur itself and the industry who really like it versus, but they have to have like an MVP that they're putting out. Like the products have to got built and now they want to test it with users. That's what we're testing for growth.
Going once? Going twice?
Manny,
Final question.
So this might be more of a question for coaching from a CEO on the entrepreneurial side, but seeing as you're here, if you don't mind.
Mm-hmm.
So I'm not a young up-and-coming entrepreneur, I'm an old up-and-coming entrepreneur.
You're becoming.
Yeah, I'm becoming. So I have had my own companies and I've never had a startup or anything like that. We had our beta built last year, we got our MVP just ordering basically this week. So very exciting about the next couple of weeks. We've had a couple of $50,000 checks written. And when I say we, that's a big lie, it's just me. And so I'm at this point, I'm going like, well, how to meet the Mannys? Well, Manny wants an introduction, and how do I meet the Johns? And I really, like I've joined Vitech and I've met with Peter, and I'm out there talking to other CEOs, but to be honest with you, I'm having troubles getting past the emails and getting to the angel investors and getting those introductions. And like, how do I meet you guys? Like, when I come up here at this event and I go up to John and I say, hey John, I'm Ian, how do I get him interested? Because he's going to walk away and go, well, may or may not remember a great conversation with me, but the rule is that I'm not pitching you tonight. So I'm actually really lost at that point. And I'm asking you, how do I get past that?
So, the way most people get a hold of me is I've got approximately 6,000 connections on LinkedIn.
Yeah.
More than likely, we're a secondary degree connection to somebody.
Yeah.
So you can easily ask someone through LinkedIn to connect with me. I'd be surprised if through those networks like the angel groups, you couldn't get connections into people. That really would surprise me.
Yeah.
Because there's some key connectors. I don't know Victoria as well, so I apologize for that. But I know Vancouver, I know Toronto, and a lot of other cities. There's 3 groups in Vancouver. If you're either an Open Angel, Vantech, or Angel Forum, you know the angels. Or if you know a lawyer, right, who can make that introduction, who knows somebody in those groups. And so that would surprise me. I think that's just some research that needs to be done on that side. But that's typically how people get a hold of me in terms of that's the first piece. LinkedIn and those groups. But it's just meeting them. And then it's the professional services firms as well. A lot of people, my accountants sometimes send me deals, my lawyers send me deals, and they're the ones who know me very well. But that's key. That's just a simple filter. You know, I akin it to like a GPA, right? A GPA when you're going for a job doesn't really matter, but for a university when you're applying, it matters a bit. But you know, the candidate who's got 2.8 GPA or 2.85, that 2.85 is not a better candidate, right? Just because I don't know you doesn't mean you don't have a good business. It just means that I need to find some filters that allow me to get it down. Because I think we checked, and last time I had over 1,000 deals sent to me last year, right? I would go nuts, right? I would be divorced, and my son wouldn't know me, right? If I was looking at all of these deals, just to click and open those, right? And see what's going on. So that's just, I call that a basic filter I do. Like, you know, I had a company get upset at me a couple days ago because their valuation is 5.5, and I said I only look at deals at 5. Simple, pure stop. I just don't. Unless there's a compelling reason or one of the guys I closely work with says, man, you need to look at this. I just don't, right? And so I've got those basic filters that are just ways to filter down that pipeline. But some angel investors might not have that. Like, you know, John might have different tools that they use for that. But that's kind of what I do to get the narrowness of what we're looking at.
Sure.
Yeah.
Okay, thanks.
But I'd be happy to chat with you now that we know each other.
Awesome.
Yeah, he's asking for advice. Yeah, great final question.
Yeah, and so I just want to thank our great guest. Thank you so much for coming.
Thank you.